So welcome everyone. Welcome to our session of Agile Ontario, friends from around the world. And as always, I'm on the international spaceship, watching all the friends on the world. And today we have Vasco Duarte joining us from Helsinki, all the way from warm Finland, 10 degrees Celsius, and getting warmer. Does it sound familiar with the other ones here in Toronto? Yeah. We are in the same boat as Lucy. So it has been an amazing time with how we have started this Friends from Around the World a series, and we have brought so many amazing speakers that we couldn't pay the tickets to bring them here, but we can bring them in this virtual world, and they still can share with us their experiences, their knowledge, their everything they have learned, and leave golden nuggets for us to think about or to bring to our teams as soon as we leave. So today we're going to talk about estimation. I know it is a topic that probably we have spoken a lot, right? We have talked about it a lot, but there is always people that join and they have questions and they are new to this topic and they cannot even think about how can you go without estimations. I cannot even understand that. So I can't find a better person for this. So Vasco is one of the originators of the NoEstimation hashtag that has been going on for years now. So I am very happy to bring Vasco in our group. And I'm not going to say much. It's just welcome everyone. Welcome Vasco. The floor is yours.
Hey, thank you, Ardita. And the NoEstimates hashtag is now 10 years old.
Is it 10 years?
Yeah, 10 years old. Woody started, I had started the conversation on Twitter. Woody had started the conversation on Twitter. And he was the first to use the NoEstimates tag. I was using another tag. But very quickly after Woody used the NoEstimates tag, then it just took off. Like people were talking about it, and then, of course, the conversation grew from there. I have been practicing something related to what is today NoEstimate since 2008. I've been struggling with these problems, of course, much before that. And writing and speaking publicly since 2012. So there's a huge community out there using and practicing and writing about NoEstimates. I've got some podcast episodes about that on the Scrum Master Toolbox podcast, many blog posts about it, and of course the book, which you see right here. And if you pay attention to the chat, I will paste in a link for you to go and download it in a second. But let's get started. You guys are all on your lunch break, I hear.
Yeah, they're probably chewing, but that's not noisy, so it's okay.
No worries. You can make as much noise as you want as long as you're on mute. All right, cool. So the talk that I suggested to bring here was to describe why all attempts to improve estimation have, and my contention is, will continue to fail, and of course what to do instead. But before we go to the what to do instead part, it's important to understand why it's not worth it to try to improve estimation as a practice, right? So let's go on. So because of course I understand that in a short session like this you can't go through all of the ideas. I do have a gift for you. So I will paste the link in the chat. So if you go to the link in the chat, you will be able to sign up and get the book, the whole book. So no strings attached. You get the whole PDF so that you can read the book on your own. All right, but let's go through the main argument here. So a recent study by the Aalborg University, this was a study published in 2002. They looked at 258 major international transport infrastructure projects. Let me just be very clear that what this means is that estimation is not a struggle for software projects. It's a struggle for all projects. These projects had taken place between 27 and 98, and they found that the actual costs of those projects were on average 28% higher than the estimated costs. But here's the kicker, this is the most important. 9 out of 10 of these projects, costs were underestimating, resulting in cost overrun. Think about this, 9 out of 10. Now pay attention to this 28% number, it will show up again. But it's an important thing to understand that the fact that the average is 28% higher does not mean that somehow most projects succeeded, right? 9 out of 10 of these projects underestimated their costs. So here's my contention based on this data. Projects are not the best tool if you want to contain costs or hit a particular deadline. And both of these are necessary, in some cases, necessary constraints that we need to take into account. So given that in mind, or keeping that in mind, what this article clearly shows is that projects are a bad investment strategy, right? If we look at a project as some money we put on something in order to get a particular return, obviously we want the return to be positive. And what the previous article just showed, and the link is there, I'll send it to Ardit and she can distribute it. What the previous article showed is that 9 out of 10 underestimated the costs, i.e. the costs were higher than what they estimated as they started, and the average was 28% higher. Now, again, the fact that the average is 28% higher, that means that many projects were just around 28%, some might even be less than 28%, but there's a few that were way above 28%, and we'll get to there. We'll talk about this outlier effect in a minute. So let me just show you how bad an investment strategy, though, projects can be. And for this, we'll take an hypothetical project where there are 10 tasks in the critical path, and each task has 1 day duration. What this means is that the perfect estimate would be if the project takes 10 days, right? So they were estimated at 1 day duration. Now we execute, now we figure out how long it actually takes, and then we compare it to the 10 days, and that's our accuracy. So what happens if we take one of these projects, 10 tasks of 1 day, lasting 10 days in the perfect case, and we simulate that 1,000 times? So what happens then? Okay, so here's the simulation. What I have here is the distribution of the number of instances that, or sorry, the number of instances here that were at 10 days, 11 days, 12 days, 13 days, 14 days, 15 days, okay? If I look at the cumulative probability, what I see is that the probability of a perfect estimate, even for a project of 10 tasks, is 4.6%. Right? The probability of the project lasting exactly 10 days is 4.6%. In order to be 75% confident that you're going to give the right estimate, you would have to estimate it at 12.9, so around 30% higher, close to the 28 we just saw. And the 50% confidence, so the coin in the air estimate, would have to be at around 12.37% higher. Or rather 23.7% higher, so 12.37 days. The median project duration in this simulation was 12.4 instead of the 10 that would be the perfect estimate. Now it's important to understand how this simulation is done. In this simulation, we're using a Weibull distribution that is limited. What that means is that there's only so much you can go after the estimated duration. And as you can see here, the cumulative distribution ends at 15 point something, right? So there was no project that lasted more than this. And this is because we're using a very optimistic actuals distribution, the viable distribution, that does not take into account, for example, catastrophic errors of estimation, and tries to simulate data from the field, right? So it tries to simulate the actual data observed in the field. But of course, some people would say, wait a minute, so a 10-task, 10-day project is kind of a toy project. I mean, how many projects do we run that only last 10 days and only take 10 tasks? Not very many. All right. So what happens if we take it one notch up? So 100 task, 100-day duration project. Now, some of you might say 100 critical chain tasks is still a rather small project. But doing this 10 to 100 order of magnitude jump will help us do another analysis. I'll come back to that in a second. All right, so now simulating the same project now with 100 tasks 1,000 times. What we get here is the minimum project duration, i.e. the shortest duration of any of the 1,000 tries was 116.8. So rather around 17% overrun. That's the minimum duration. That's not the average, right? The probability of a perfect estimate in this project is 0. So in 1,000 instances, there was not even one project that was delivered on the optimal delivery date, so 100 days later. And if I look at the median project duration, that was 124.6, which is not very far from what we saw before. And the 50% line was around 124.53, so 124 days and a half. And the 75% confidence line was at 126.17. This is a viable, or what we are using here is a viable distribution that is truncated. So don't forget that in real life, the distribution of actuals does not have an upper bound, right? It can go much worse than this. Also, this simulation implicitly assumes that you don't have one task being interrupted by other tasks outside the critical chain, which of course is not realistic in real life. There are critical tasks that are interrupted all the time. You know, sickness, somebody leaving, a pet project coming up, a tap on the shoulder, an email that is sent. So we're here in this particular example, we're looking at a very optimistic projection of what a project of 100 tasks could look like if executed 100 times. And we have not even one instance that delivered on time. So probability of the perfect estimate is 0. And if I look at the median project duration, it's around 25% higher than the perfect estimate. So if this is the case here, you can only imagine what would be the case in real life. Remember, this is a simulation, has many optimistic assumptions inbuilt into it. The interesting analysis, though, is how quickly does it get that bad, right? We went from 10 to 100. But how far do we have to get away from 10 to start to witness some of these catastrophic behaviors of the system? In other words, is a project fragile to the size of the number of tasks? It's a fair question, because as I said in the beginning, a 10 task critical chain project is, or critical path project rather, it's kind of an anecdote, right? Like it's a toy project. It's something we do in our weekends. It's not what a company usually goes through. All right, so I did this. I did the same simulation for projects of many different task sizes. So number of tasks, right? From 1, there's no project with 0 tasks, obviously, but from 1 all the way to 30. And here's how quickly the probability of on-time delivery, that's including a 10% error deviation, right? That's okay if it's 10%, I still call it on time. And if I look at this from 1 to 30, you can see how quickly it declines, right? Around 10, which is the number we saw, we have this probability of delivering on time. Rather, that was not the right direction. There we go, right? So a very low probability of delivering on time for a 10 task project. But when we get to 30, we're essentially at 0. Right? So now think about this. What this model shows is that under optimistic and truncated actuals distributions, a project of 30 critical path tasks will have a near 0 probability of delivering on time. If the errors were linear, as we are promised by the estimators, by the way, if the errors are linear, we would see a decrease in accuracy like this, right? The number of tasks would only have a linear impact on the accuracy of estimates, but when we look at this model, we see a big difference, right? We have this line, the blue line, which is totally different from if errors, estimation errors were linear. So this also shows the difference between these two lines, shows also the difference between the promise of estimates and the reality of using estimates to deliver projects. This is nothing new though, because there have been other studies that have looked at project failure and the impact of estimation in project failure. And they look at the cost overruns, and they analyzed, or they came to the conclusion that cost overrun is systematically fat-tailed. So what systematically fat-tailed means is that the errors within the cost estimates are very easily growing exponentially. What that means is you have a performance that looks like this blue line that I showed you a moment ago when it comes to delivering on time, right? This is the number of tasks, and as this grows linearly, the precision or the accuracy of estimates decreases exponentially. So this is in contrast with understanding overrun in terms of errors or randomness, also known as the Gaussian, right? We're all familiar with the idea. Yeah, we're going to have some errors, but they kind of, they even out, right? Well, that's not true. That's not what happens. And by the way, the article is here. You can go and check it out yourself as well. So what this article shows, though, is that what we observe out there in real projects is that project failure because of estimates is entirely consistent with the model we just looked at. This is important because now we can start to analyze why projects are not delivering on time, and then we can start to generate, brainstorm, and experiment with methods, approaches, strategies to deliver on time. We are all familiar with this. I won't bother you too much with the details, but these are just some examples. You can quickly Google the F-35 project budget or the Berlin airport project cost overrun, and you'll find that. So now we look for alternatives. And here's the basic idea behind the alternative that I'm proposing. I'm proposing that when we look at the performance of a system, so several teams working on a product or a software that needs to go into production at some point, we can use network throughput as an analogy to analyze, measure, and understand the performance of a system that delivers software. And of course, a system means all the technology, the people, and the processes that come together to deliver that software. And you see that in a network, there are outliers, right? There's sometimes throughput mountains and or peaks and valleys, right? But if you draw a line like this, you're basically capturing the majority of the performance data points of the system. There's very few data points outside this system. Now, there's still a problem with this. I'll come back to that in a second. Here's what happens with the software team. This is data from a software team, and we see the same type of behavior, right? So if I draw a line here and here, I'm capturing most of the performance of the system, the data points of performance of the system. So we can use this network throughput model as a method, an approach to also measure software team or software system performance model. And here's my proposition. Based on this, I'm proposing that our rate of delivery will be the same over time unless significant changes happen to the team or the system of teams. And again, a system here means the people, the technology, the processes that are in place that at the end generate the value, the software we're looking for. I also propose this. This is my proposition 2. We know that we know at all times how many items we have in our backlog. In fact, this should be easy enough if you're using software that counts the that contains all the items to be delivered, like Trello, Jira, Rally version 1. I think that's the Rally version. So you can check the system itself, like whatever backlog management system you're using, and you can count the items. So proposition 1 is we know our rate of delivery and we can expect it to be similar over time unless significant changes happen. And by the way, when it stops being the same, we can also assume that significant changes happen and we can then do the investigation there. And also we know at all times how many work items we have in our backlog. If those two are true, knowing the backlog size, knowing where we are somewhere here, right? Like this has been the past performance of our system. We can then, if we are here, for example, we can then project the delivery over time, right? Where the blue line is the optimistic line, the red line is the pessimistic line, using the upper bound and the lower bound of performance that we measured using the throughput model. And with this, we can easily detect whereabouts are we going to land. Now, if you look at a graph like this, if your deadline is here and your window of delivery looks like this, then of course you're late. And if you're late, there's one very simple thing you can do, which is to go here to the backlog and decrease the number of items so that the optimistic is there and the pessimistic is there. There's still a chance you don't deliver on time, but of course you have reduced the scope, and this is very important. This delta here is one of the most important tools we have in order to deliver on time. In the NoEstimates book, we talk about how do we establish a trustworthy backlog, right? So backlog we can use in these terms. How to track the rate of delivery. There's some steps to consider. How to use these data points to forecast. That's not using estimates. So we're not interrupting the teams and somehow asking them for a magic number or a magic letter. We're actually looking at the data and we're projecting that into the future. And finally, the most important tool, we talk about scope management, which is, if we're honest, the only tool we have to deliver on time. Because we all know that software projects only get bigger. They never get smaller. And because of that, we need to use scope management. I call it preemptive scope management, right? Like we're constantly looking at the projection and then constantly managing the scope in order to hit the target that very often is set from the outside. Like, for example, if you have a consumer product, just go out for Christmas. There's nothing you can do about it, right? Like, no amount of arguing with Christmas will make it change its mind. It always comes on the 25th of December. But that's not all. Let me show you this particular nugget, this bonus. This is, by the way, under this bit.ly link. The presentation will be available later. You can check it yourself. This is a whole thread where I analyze a PhD thesis that looked at 3,000 plus projects and talked about the accuracy or the value of using estimates in order to predict and manage those projects. Here's what they found. First thing, the outliers are the projects that are extremely late or extremely more expensive than they were estimated to be, right? That's what outliers are. And the researchers say outliers are so frequent that the noise drowns out the signal in the data. What they basically mean with this is that if you just look at outliers, that's enough to know the performance. You don't need the average for anything. You can just look at the outliers, and that will tell you the performance of estimates in software projects. So, in other words, even if you have data from the actuals, you don't really know if you will be late because the outliers So the tasks that are extremely late are only visible after the fact and have huge impact on delays. But that's only one of the highlights of this thesis. They also talk about Kmart. Kmart is an American supermarket chain, and they went bankrupt. And here's the thing, they went bankrupt because of a loss of 244 million US dollars at the same time that they were executing a 1.4 billion IT modernization effort. So at least in Kmart's case, we can actually claim that the errors of estimation had an impact, perhaps even not trivial, had an impact on the bankruptcy of that organization. As I said, projects and estimates are not a very good investment strategy. And this is the facepalm moment. The estimation researchers, so not the people who wrote this paper, but the people who analyzed the projects that this paper then analyzed again, researchers, when faced with a large amount of extreme cost and schedule overrun in IT projects, chose to ignore those and use only the observations that fit the normal distribution, which is entailed when, as we talked about before, the errors of estimation are much more likely to be fat-tailed, right? Like a power law. Therefore, hiding the fat-tailedness of estimation errors. This is very important because basically what this says is the studies that corroborate the value of estimation remove from consideration the worst offenders when it comes to the performance of estimation. But because of what we just saw in the first highlight, the outliers, i.e. the worst offenders, are so markedly different from the rest of the projects that these themselves are enough to characterize the data set. In other words, what researchers are doing when they look at the performance of estimates is hiding the signal and showing you the noise. This is very important, and this is why it's so important to figure out a way to work without estimates using different methods. The projection method is the one I describe in the book, but there are many others. The book was published in 2016. Since then, I've written a lot and I've given workshops about other things that I have discovered on top of what's on the book. So the state of the art has advanced greatly since the publishing of the book. But the book has one method. It's a method you can start using right now, and it has the advantage that you don't actually need to convince anyone to start using it because you only need to count stories and do a very simple projection. All right, that's it from my side, and now I'll open up for questions.
There are some comments around here. Mike, do you want to go with the outliers being the norm?
Sure. Hi, everyone. Hi, Vasco. You just, it was it was very interesting in your slide. You were saying that, you know, the outliers were so frequent that, and then you went on to explain everything that you explained. And it just made me think, well, hold on. If the outliers are that frequent, are they even really outliers anymore? Because then they're just actually part of the normal distribution, not distribution, but they're part of the normal system because they're not outliers because they're that frequent.
In fact, so that's a very good point. So let me expound that on a little bit more. I didn't say that outliers are so frequent. I said that the impact of outliers is so large that by excluding them from study, they hide the real performance of estimates, right? Remember the first slide where they looked at, let me just, how many projects was that? This slide here, and they looked at 258 projects, right? And they found out that the average average cost overrun of those 258 was 28%. But that doesn't mean that they were all around 28%. That means that some were like 10% plus, maybe a couple were even on target, but then there were a couple that were like, 10 times more expensive than what they were supposed to be. But here's the thing. When you look at that population, the ones that were 10 times more expensive are the characteristic of the data set. They are the most important signal of the data set. That's what I'm trying to say. And what this tells us is, and I mentioned this in the overview slide of the NoEstimates ideas, what this tells us is that if we're not doing scope management effectively and from the start, we are exactly doing what those outliers did, which is find out that we're late, way too late, therefore not being able to recover. And I mean, in Agile, we know this since the 90s, right? What's one of the most important principles of the Agile Manifesto says, we satisfy the customers through early and often delivery of working software, right? So the early and often delivery of working software is the technique to get out of the outlier trap, because you can cut the scope. When you use estimates, you begin to think that because we estimated it, we will deliver on time and on cost, and then we are not ready to cut the scope. And in fact, many of you guys already have experienced it when you get close to the end of the project, and we've made so many decisions up to that point that we can't cut scope anymore because everything is dependent on everything, and if you stop one, you stop everything, right? And that becomes a very nefarious anti-pattern, which is what I call the scope managing you instead of you managing the scope, right? So when we get out of estimates, we don't accept that anymore. And we even say, and this is one of the things I tell my clients all the time, what you want is the bad news as early as possible so that you can react to it. If you do this projection that you have now on the screen, and you find out on day 2 we're late, awesome, you can cut scope now and you still have a lot of degrees of freedom. The earlier you start that conversation, the better. And that's why this forecasting model is a great risk radar. And it's a radar that speaks to you, if you believe it, obviously. It's a radar that speaks to you without political involvement or emotional involvement in what's going on. Why is this important? I'm not saying that emotions are not important. I'm saying that somehow, somewhere, you need to have a piece of data that is telling you if you are lying to yourself. And believe you me, we are the best at lying to ourselves. Right? Very often I use the phrase from Scarface, never get high on your own supply. And this is because the worst offenders are project managers. Because they are the ones doing the process. They start believing the estimates. It's not the teams. Most teams don't believe the estimates. It's the project managers that believe the estimates. Right? And of course, the project managers are the people who should last believe the estimates. They should be constantly working on managing the scope and trying to act preemptively, which is what I recommend and discuss in the book how to do.
Jeff, do you want to go with your options?
Yeah, for sure, Artie. Vasco, this is a great overview on the topic, one that I, as you know, have been following along for quite some time. Wondering how you can talk about having to make a decision when I've got multiple options in front of me, 6 things, and I don't know which one I should do first. And I want to do effectively a cost-benefit analysis. And a cost-benefit, it requires some denominator, it requires some sort of costing or estimate of some kind to do that. I'm wondering if you've approached that in a different way, or how you do a cost-benefit analysis, or if you don't. I'd love to hear your take on that.
That's a very good question, Jeff, and one that I would like to take from the perspective of an investment decision. Because don't forget that you don't do cost-benefit analysis on money you want to throw away. You only do the cost-benefit analysis on the money you want to recover, right? You want to get some benefit out of that cost that you have, some sort of return. So we're actually, when we deliver software, we're not executing a project. This is the first and major metaphorical mistake we do in our own narrative of what we're doing. We're actually making an investment. And there's no successful investor in the market who would invest all of their money into one share or one company? No one. The first thing they do, they spread their bets. Right? I mean, we call this the diversification portfolio theory. There's a bunch of investment literature and strategies that have to do with that basic idea of never put all your money into one thing. And somehow in the IT, we must all be geniuses because we somehow believe that we can put all our money into one bet and get all our money back. Now, we know that's not the case. And in fact, the article that I'm referring to on this slide tells us that you need to expect an average cost overrun of 28%. Whatever the cost is, by the way. Right? Even if you buffer it, the average will still be 28%. So what do we do? It's a very fair question. I have option A, B, and C. I need to get some value out of it. I kind of have a speculation about what the value is for each of these options, but I have no clue how much it costs. How can I make a decision? Great question. First thing is, first, you have to say, I don't know how much it costs. Second, you have to know that whatever you think it costs is going to cost more if you use estimates to cost it. So now I ask, okay, so what do smart investors do when they are faced with a very similar situation? I have to invest. Where do I put my money? I mean, there are thousands of stocks out there in the stock exchange. Like, where do I put my money, Vasco? Great question. I don't know where you should put your money, but I have a strategy to share with you about how to decide that. It's called the Kelly criterion. It's an actual investment strategy, and it's very simple. You put a small percentage of your money into one of those options. You measure the outcome on the short term. If you get some money back, you invest some more. If you lose your money, you stop investing. Right? This is basically what the Kelly criterion is. A bit more complicated than that, but that's the basic strategic definition. So why can't we do this in software? Well, I mean, come on, Vasco, we have to put money into the project before we know if it delivers. All right, come lean startup to the rescue. Why don't we do an MVP? Well, yeah, but the MVP is still very large. Okay, great. So what's the assumption behind the MVP? Can we test something that is not the MVP but tells us if the MVP has value? And now we go into experimentation-driven development, which is another thread of the NoEstimates movement that I've been talking about that relates to, and this is the key word that Jeff already mentioned, relates to options thinking. When you have to make a decision and you don't know the cost of either or all of the options, the first most important thing to do is never to assume you know the cost. Therefore, you have to start the investment strategy from the perspective of not knowing the cost, and we use something like the Kelly criterion, which when we look at it, it's not very different from time boxing. Right? So we time box the time we put into option A. We evaluate the outcome, for example, show it to prospective customers, pre-sell a product that isn't yet built like, Elon Musk does, and he's not that bad at investing, right? Pre-sell a product that doesn't even exist. Hey, what the hell? Why not? If nobody pre-buys it, there's no way we are going to manufacture it. In fact, there's a whole cottage industry based on this basic idea like Kickstarter and Indiegogo and so on. There's a whole cottage industry around pre-selling products that haven't yet been produced. So when we start to look at the problem rationally, with the intention to win, because we're in, it's an investment, right? If we start looking at this with the intention of winning something, we can't go with strategies that have an average return of minus 28%. Like, makes no sense, right? Let's say you go to the bank and you say, dear banker, I have $100,000 to invest. Would you please advise me where to invest them? And the banker turns to you and say, hey, I am a good investor. Therefore, I can promise you I will only lose 28% of your money. But that's 75% of the cases. There's a chance I could lose a lot more. And this is what we're telling our bosses when we present an estimate, right? By the way, it is the estimators, the PhDs in estimation, that say that a good estimate is 25% off 75% of the time. Right? So 25% off, so wrong, 75% of the time. They don't tell you what the other 25% of the time, what's the performance there. They only tell you that, 75% of the time we're going to be 25% off. That's your margin. Right? But when you go to a bank to do an investment, you don't accept those kinds of odds. You would fire your banker immediately. This is what estimation promises. I'm not making this up. It's written in peer-reviewed papers.
Mm-hmm. Alvaro is hitting on tasks not being all the same. Alvaro, do you want to add into that?
Yeah, I was just thinking about what you were saying, right? The assumption with this approach would be like all tasks will be the same, right? Because that's not reality in life.
Yeah, and that's a very good point and a valid point, but it's also true of network throughput. Not all packets are the same.
Right. So in that case, so just trying to connect the dots in here. So in that case, what you're saying is that what we should be looking is at the system behavior and only focus on those outliers of the system.
Well, so that's a strategy, absolutely, and it's a valid strategy. I'm not saying only focus on the outliers. I'm saying that look at the system, the first part of what you said, and assume that should no big change happen in the system, the performance will continue over time.
Right, okay.
That's what I'm trying to say, right? That's okay. Proposition 1.
I understand. Thank you for clarifying that.
Anyone else has any questions? While you think, maybe I can bring something on my side. So Vasco, how do you help your customers that probably are in a situation where they are contractors? So it's a company that continuously offer contracting projects to their clients, and they do need a time and money to write a contract in order to start the work or to win the bid, and of course knowing the estimations early without even knowing the client, sometimes they get into trouble.
And by the way, very often make a bid without knowing the scope,
or know very little of it. Yeah.
And on top of that, without knowing the scope and without knowing the teams that will work on the scope, because the teams are busy with other projects and they cannot be interrupted, because that would represent a loss.
So tell me, how do you lead them? How do you guide them through this?
So a friend of mine is writing a book. There we go. Jacopo Romei. It's called Extreme Contracts. Right? Mm-hmm. This is in Italian, so you can't read that, or maybe some of you can. But he's writing it in English, and there's a few blog posts on the scrummastertoolbox.org. You can search for it, find Extreme Contracts on the site, and you will find those. Because what you're describing is actually a contracting problem, not an estimation problem. And he presents many different types of contracts, some of which may or may not fit your particular context. So that's number one, extreme contracts. And Jacopo is on Twitter, and he's happy to talk to you. Just follow him and ask him a question. The other thing is the book itself, the NoEstimates book, also comes with videos of interviews of practitioners. And within that group of, I call it the digital library. You can go to noestimatesbook.com and you can check out the list of interviews. Within that, you have 2 CEOs exactly in that role, right? Owning a company that develops software for others. 2 CEOs sharing how they bid on projects even before they are defined. So we don't have a backlog. We don't have a team, and they still need to bid on them. I do want to say that this is a different problem than estimating a project that you already know, right? Those are 2 different problems.
Or we know only we know 28% off, or we know what is it? There's a
Yeah, I mean, we know very little is the words you used a moment ago. I don't know if it's 20%, but the phrase I usually use is that software projects only grow, they
Yes.
never reduce in size.
Yeah.
Right? So whatever estimate you come up with at the start, you're already wrong.
Yeah.
Because the software, the requirements will grow anyway. But the important thing that I wanted to say is that bidding on a project is a different problem than estimating a project. Even if you would know the project, you may not want to bid on the total estimated value, or in this case, cost of that project, right? Give you a concrete example. If you know that your customer is going to generate $10 million with that software, and the software would cost you $20 to produce, you would never suggest that he would pay you $20. That would be ludicrous, right? You would say, hey, 1 million, right? It would still cost you 20. It doesn't matter. You would charge 1 million. The customer would be happy because they can make 10 million out of it. And this introduces a huge problem in our discussion, which is very hard to distinguish. One thing is the cost, the other thing is the value. And these are not the same. And if you're producing software for a third party, you have to be pricing on value, not cost. It makes no sense. Software only makes sense in 10x domains. So domains where usually you generate 10 times more value than it costs you to produce the software. If that's not the case, step out of it, because software is extremely expensive and unpredictable, right? I very often say, never underestimate the power of many hands typing on a keyboard instead of a computer doing it for you. Right? There's this famous phrase in The Matrix by Mr. Smith, never send a human to do a computer's job. The same is true for us. Never send a computer to do a human's job. Right? So because we want to price on value, not cost, the most important conversation we need to have with our customers is, what's the value? Why would we price a project at $100,000 if we knew that the customer is going to generate $500 million? Like, that makes no sense.
What if they don't tell you the value that they expect?
Well,
Because
if you're not in a, that's a very good point. If you're not in a collaborative relationship, don't expect them to then allow you to go over budget without charging you for it.
Mm-hmm.
Right? If you're already in a head-to-head relationship with a customer, then maybe you should get out of it.
Yeah. Jeff is also chatting here. Jeff, do you want to start with how do we estimate the value? Yeah, we're going into estimation, but still.
Yeah, I'm just curious, Vasco. The second question there is, how do we know the value without maybe doing some estimate on what the market size is, or what we think the potential return on? So I'm not talking about estimating in terms of forecasting a date like you are, but maybe you could talk about estimating in terms of what we think the potential value of this opportunity is.
Yeah, that's a very good question, Jeff, and a very valid one. So the first thing that matters here is that even if you don't have an estimate for value, you can have just a hope, right? The first thing is that estimates of value are as likely to be wrong as estimates of cost, effort, or duration. Because of that, it's incumbent upon us to validate that estimate of value as quickly as possible. This is why sub-communities like Lean Startup in the Agile community are so important for our growth as an industry. Because we do not want to invest a large amount of money. And let's be honest, people's time, energy, and health, because the level of burnout in our industry is unacceptable at this time, we don't want to do that if there's no actual value. Yet we are doing that. So I think that if we're to be honest with ourselves, we have to say that we're as bad as predicting value as we are at predicting cost, effort, or duration. So yes, you can have a target, right? Like, and market sizes, you can estimate based on data, right? You can actually look at, how many people have an Android phone that also go to the gym, right? You can have those data. You can extrapolate from those data. So it's not just, finger in the air. Is this a 5, an 8, or a 13, right? It's a totally different thing. But in any case, even that can be wildly wrong. So what we want to do is to quickly validate. Okay, let's put out a landing page. Let's check if people with an Android phone that go to the gym are actually interested in this kind of service. And also very important, can we reach them? Like, do we even know how to market this service? Because that's also a very important assumption that somehow never gets factored into the cost estimates, but it's the most important assumption, right? What's the use of having a running tested piece of software that doesn't have a way to reach its customers?
It sounds like all the situations that we are hitting are showing complexity, right? We are in a complex world. And there is a question on the chat about, like, what about the complicated or the obvious domains?
Yeah, so there is no software project in the complicated or obvious domain. There might be businesses in that domain, but definitely not software projects. The moment you put two people into a room and you ask them to collaborate, you enter the complex social dynamic domain. And unless you are a person gifted with extreme human understanding and foresight, you have to accept that you are in the complex domain.
Mm-hmm.
And I don't know about you guys, but even when I do projects on my own, I get surprised with how much stuff I didn't know when I started. Now, of course, it might just be my failure, but I'm venturing that it's not just me that deals with that kind of problem in our area of knowledge work.
Yeah.
So I would say that the moment you add the social aspect to the delivery of software, you stopped being in the complicated or obvious domain.
Mm-hmm. Any last minute questions before we let Vasco go? Did anyone get anything valuable from this session today?
Completely. Great question. Absolutely valuable.
Mm-hmm.
I'll be working on it. Cool. Can I reach out to you on LinkedIn and share what because I took a course by Scrum Alliance that talked about no estimates, or it was basically Kanban with Scrum, and it was no estimates. It's really about predictability and throughput, and so it resonated with me what you talked about. So I'm looking forward to experiment. I've been starting to experiment at my work, and I'm looking forward to sharing with you what has come out of it. Yeah. Thank you for the offer of your book also.
Yes, we all got out as gifts. Thank you, Vasco. Fantastic. Well, I think we're at time. This was really great. Thank you for the gifts. Thank you for the knowledge. Thank you for the shifting of the how we look into problems, right? Don't look at it like this, but look at it like this. That even just that helps us into how to continue and how to manage the work in hand. So you can find Vasco on Twitter, on LinkedIn. He is everywhere. I found him, so you can find him. So with that, thank you so much, and we'll see you in our future sessions.
Thank you, everybody. It was a pleasure to be here. Stay safe.
Thank you.
Thank you.
Thank you. Bye-bye.
Bye.